The markets had already adjusted that down to maybe 2 to 3. So one of them they kind of took off the table. So people were expecting a hawkish cut today, in that the Fed was going to cut rates, but simultaneously indicate that it wasn't going to cut as much as it had thought before. But I guess the markets hadn't fully priced in or considered what that means, because this whole stock market rally has been predicated really on lower rates, and the idea that this new easing cycle is going to propel the market higher, just like prior easing cycles. And I've known that there was going to be a lot of bumps on this road, because I knew that the Fed was not making the progress on inflation that it had believed, or that it was claimed that it was having. And I think this was reality setting in when Powell talked about how inflation had picked up, how inflation was higher than the Fed had hoped or had anticipated, that it's taking longer to get inflation down to 2%. In fact, in the Q&A, that he thinks it may take 1 or maybe 2 more years before inflation goes down to 2%. Now, I don't think it's going down to 2% at all in 2 years. So it's going to be a long wait. But if the Fed is going to have to wait 2 years to get inflation back down to 2%, well, it's going to have to be higher for longer than the markets expected. In fact, Powell indicated that the neutral rate, the rate that the Federal Reserve believes is neutral for the economy, not stimulative, but not restrictive. They notched that up from maybe 2.8, 2.9% to 3%. And so that also means that there's fewer cuts necessary, maybe one less cut, to get down to where the Fed considers policy to be neutral. Now, the Fed did say that they still think they're well into restrictive territory. They lowered interest rates now down to, 4.25, 4.5. So we're now a full 100 basis points lower than the peak. Although, despite this 100 basis point rate cut, the yield on the 10-year Treasury, which closed above 4.5 today, is now better than 80 basis points higher than it was when the Fed started to cut. So the Fed went down 100, but the market went up 80 on the 10-year, and even a little bit more on the 30-year. This hasn't happened in recent times, where the Fed has been cutting and the market has been moving in the other direction. And this shows that the markets are not believing the Fed to a degree. They're concerned about the growing deficits. In fact, they have this continuing resolution that is working its way through Congress now to keep the lights on, and that includes $110 billion of new spending, in addition to all the other spending, an extra $110 billion. Also, they threw in a raise. I guess that Congress is upset they haven't gotten a raise in the last 10 years. So they slipped a pay hike for themselves into this continuing resolution. But that alone adds another $110 billion to the debt over the next year, in addition to everything else that's adding. They're talking about the DOGE commission to cut spending. They're already increasing it beyond where it already was. And in fact, the House of Representatives passed this Social Security Fairness Act. Who's going to be against Social Security fairness? But what it does is it increases benefit to civil service workers who are getting less benefits. Now this is going to change that, so they get full benefits. That costs an extra $20 billion a year. Just throw that onto the pile. And of course, if they estimate $20 billion a year, it's probably going to cost a lot more than that. But these guys are still adding on new government spending as deficits are exploding out of control. So the bond market is concerned about this. Now, I think it would be a lot worse for the bond market if the dollar was falling, but it's not. The dollar surged today to a new 2-year high, dollar index above 108.
In the ever-shifting landscape of financial markets, gold and silver continue to stand as timeless assets, impervious to the whims of fleeting optimism and market euphoria. As central banks adjust their monetary levers and global economies navigate the challenges of inflation, rising deficits, and geopolitical tensions, these precious metals shine as safe havens of value. Today, we delve into why gold and silver are more relevant than ever in this volatile economic climate. The Federal Reserve's recent actions have sent shockwaves through the markets, underscoring the precarious balance between inflation control and market stability. Chairman Jerome Powell's remarks about inflation lingering above 2% for at least another 1 to 2 years highlight a significant shift in the central bank's stance. The acknowledgement that inflation remains stickier than anticipated has cast doubt on the efficacy of the Fed's policies. While the Fed has implemented rate cuts, reducing its benchmark rate to a range of 4.25% to 4.5%, long-term Treasury yields have stubbornly risen, defying conventional expectations. This divergence between Fed policy and market behavior reflects a deeper concern about fiscal irresponsibility and ballooning deficits. The bond market skepticism is evident in the widening gap between short-term and long-term yields. Despite the Fed's attempts to cool inflation, its impact is undermined by unchecked government spending. Recent measures, such as the addition of $110 billion in new spending through continuing resolutions, only exacerbate the problem. And let's not overlook the irony of Congress sneaking in pay raises while deficits spiral out of control, a move that certainly hasn't gone unnoticed by investors. Amid these fiscal and monetary missteps, gold has quietly emerged as a beacon of stability. With prices hovering above $2,600 per ounce after briefly dipping below that mark, gold continues to defy skeptics. While the metal experienced a temporary $60 drop, it quickly rebounded, highlighting its resilience in the face of market turbulence. However, the disconnect between gold's performance and the valuation of gold mining stocks is staggering. Despite gold being up an impressive 25% year-to-date, leading miners like Barrick Gold and Newmont Mining are down 35% and 33%, respectively, from their peaks. These stocks are trading at less than 12 times earnings, a stark contrast to the broader market's multiples. This disparity underscores the extreme bearish sentiment in the gold mining sector, which paradoxically could signal an incredible buying opportunity for astute investors. Adding complexity to the narrative is the US dollar's recent surge to a two-year high, with the dollar index climbing above 108. This strength comes despite ballooning deficits and a precarious fiscal outlook. The dollar's rise has been fueled by global risk aversion and relative weakness in other major currencies like the euro, which is trading just under 1.04. Yet this strength masks deeper vulnerabilities. A strong dollar may suppress gold prices temporarily, but it also signals underlying instability in global markets, as investors flock to perceived safety. While gold garners much of the spotlight, silver's story is equally compelling. Historically, silver outperforms gold during bull markets, yet it remains underappreciated. Central banks may not stockpile silver like they do gold, but its industrial applications, especially in renewable energy technologies like solar panels, are driving demand to unprecedented levels. Despite this, silver trades at a significant discount relative to gold, with the gold-to-silver ratio sitting at an unusually high 85-1. This disparity represents a massive opportunity for investors, as silver's potential upside is magnified when the public returns to the market. Beyond their roles as hedges against inflation and currency devaluation, gold and silver serve as strategic assets in a changing global economy. Central banks, particularly in China and Russia, are diversifying away from the US dollar, opting instead to increase their holdings of physical gold. This trend underscores the geopolitical dimension of precious metals, as nations seek to insulate themselves from the vulnerabilities of a dollar-dominated system. For individual investors, the implications are clear. In an era of economic uncertainty and financial repression, owning gold and silver is not just prudent, it's essential. These metals are not merely commodities. They are forms of money that have stood the test of time. As the broader market grapples with the consequences of fiscal and monetary mismanagement, the enduring value of gold and silver will become increasingly apparent.
The euro, I think, is it down to 103? Let me check where it is. The euro is trading at just under 104. So 103 and 3/4. It closed, it's up a little bit in the evening. It was at 103 and a half, but dollar index above 108. So the dollar is soaring. It's the only thing that was up today was the dollar. Everything else, the stock market, the bond market, the Russell 2000 was down better than 4% on the day. And, the Russell 2000 is now down 1% since Trump was elected. A couple of weeks ago, it was up 9%. So we've had a 10% decline, now a full-blown correction in the Russell 2000. The QQQ was down, that's the NASDAQ 100, was down 3.6 today after hitting a record yesterday. In fact, several NASDAQ stocks had some pretty big reversals today where they hit new highs and then they got clobbered later in the day after the rate hike. Everything was down except the dollar. Gold was down about $60 an ounce today. It's up about $10. Now it's up $30. I don't know. So now it's back above 2,600. It's just regained. I don't know what just happened. I looked at the price of gold 10 minutes ago and it was up $10. Now it's up $30. So it's regained half of the $60 loss already. So we're back above 2,600 at 2,612, but we were down below 2,600 when trading closed. But you know what's amazing? The gold stocks, again, got absolutely hammered today, right? Barrick Gold was down 4.5%. I'm giving you the big ones. Newmont Mining was down 5.5%. This is how ridiculous it is. So gold, before this $30 rally, because I looked at the numbers before this rally. So before this $30 rally that we're having right now, gold was down about 7% from its peak, about $200. That's it. I mean, right now it's down less than $200 from the peak, but that's 7%. If you look at Newmont Mining and Barrick Gold, Barrick Gold is down 13% year to date. 13%. Newmont is down 8%. Gold is up 25%. I've never seen a year like this. 25% increase in the price of gold. Yeah, it's not the 30% that it was, earlier, but 25% up is a hell of a year. One of the best years for gold. And these stocks are down. Now, it wasn't too long ago, before Trump was elected, the gold stocks were up more than gold. Now, they weren't up a lot more like they should have been, but they were up more. But since their peaks, even though gold is only off 7% as of earlier today, Barrick Gold is 35% below its high. 35%. Newmont Mining is down 33%. These stocks are trading at less than 12 times earnings. So what does that tell you? About the sentiment. They're less than half of the market multiple. Hey, I'm having these technical difficulties. I was trying to text. So Paul, you got to let me know when to do the commercial break because you didn't give me a timer. So I have no idea how long I've been talking. So you got to send me a text and let me know when I need to break. I was hoping to do that without having to say it, but anyway, that's what I had to do. So where was I? Yeah, so the fact that these stocks are down so much shows you how negative the sentiment is in gold. But how negative the sentiment is in gold, that's how positive in everything else, right? Because it's the mirror image. You have crazy optimism on the overall stock market, ridiculous optimism in Bitcoin, but extreme bearishness, extreme pessimism in gold. Now, what investors don't understand, what the Fed doesn't understand.
As we dive deeper into the dynamics shaping the gold and silver markets, it's crucial to highlight the broader implications of their undervaluation. These precious metals have long served as hedges against uncertainty, and their resilience amid today's economic chaos underscores their enduring relevance. Let's explore why the current landscape makes gold and silver not just a smart investment, but an essential one. The Federal Reserve's recent rate adjustments reflect an institution grappling with conflicting priorities. While the Fed aims to control inflation, its actions inadvertently highlight the limitations of its influence. For instance, despite 100 basis points of rate cuts, the yield on the 10-year Treasury has risen by 80 basis points. This divergence suggests that market forces are increasingly skeptical of the Fed's ability to navigate the challenges ahead. Such skepticism is warranted. The Fed's focus on taming inflation is undermined by relentless government spending. Recent measures like the Social Security Fairness Act and an additional $110 billion in discretionary spending exacerbate the fiscal imbalance. These actions reinforce the perception that the U.S. government lacks the political will to address its ballooning deficits, a reality not lost on bond markets. The bond market's reaction to these fiscal missteps is telling. Rising yields on long-term treasuries indicate growing concerns about the sustainability of U.S. debt. Yet paradoxically, the U.S. dollar has strengthened, with the dollar index reaching a two-year high above 108. This apparent contradiction reflects a flight to safety as global investors seek refuge in the world's reserve currency. However, a strong dollar is not without consequences. For one, it suppresses commodity prices, including gold and silver. But this suppression is temporary. The structural weaknesses in the U.S. fiscal position, combined with persistent inflation, will ultimately erode confidence in the dollar, setting the stage for a significant revaluation of gold and silver. Gold's recent performance highlights its role as a store of value. Even after a $200 dip from its peak, gold remains up 25% year-to-date. This resilience is remarkable given the broader market turmoil. Yet the disconnect between gold prices and gold mining stocks is staggering. Leading miners like Barrick Gold and Newmont Mining are down 35% and 33% respectively from their peaks. This mispricing offers a golden opportunity for investors. Gold mining stocks trading at less than 12 times earnings represent incredible value in a market otherwise characterized by overvaluation. As sentiment shifts and investors recognize the mismatch, these stocks are poised for a significant rebound. While gold commands the spotlight, silver quietly offers even greater potential. Historically, silver outperforms gold during bull markets, yet it remains underappreciated. The gold-to-silver ratio, currently at an elevated 85-1, signals a massive opportunity for silver investors. Unlike gold, central banks do not hoard silver, making it more dependent on retail and industrial demand. However, this dependency is an advantage in the current environment. Silver's critical role in renewable energy technologies, such as solar panels, ensures robust industrial demand. Coupled with its affordability compared to gold, silver is positioned for substantial gains as investor interest resurges. One of the most significant yet underreported trends in the gold market is the shift of physical gold from west to east. Central banks in China, Russia, and other emerging economies are accumulating gold at an unprecedented pace. This trend reflects a strategic effort to diversify away from the US dollar and reduce vulnerability to geopolitical risks. In contrast, Western investors remain largely indifferent to gold. Precious metals account for less than 0.5% of most investment portfolios in the US, highlighting the untapped potential for growth. As sentiment shifts and Western investors begin to mirror the East's strategic accumulation, the demand for gold could surge exponentially. The rise of Bitcoin has drawn attention away from gold, with some claiming it to be digital gold. While Bitcoin has undoubtedly captured the imagination of speculative investors, it lacks the intrinsic value and stability that define gold. Central banks aren't buying Bitcoin, they're buying gold. Moreover, Bitcoin's volatility and reliance on speculative flows make it an unreliable store of value. As the cryptocurrency bubble deflates, disillusioned investors are likely to rediscover gold's enduring appeal. The resulting capital rotation could provide a significant tailwind for gold prices. The extreme pessimism surrounding gold and silver contrasts sharply with the euphoria in other markets. This sentiment disparity often marks a turning point. Historically, periods of bearish sentiment in precious metals have been followed by significant rallies. As economic realities catch up with market optimism, the narrative around gold and silver is likely to shift. Rising inflation, persistent deficits, and geopolitical uncertainty will compel investors to seek refuge in these timeless assets. The current economic environment mirrors conditions that have historically preceded bull markets in gold and silver. Persistent inflation, rising deficits, and a declining dollar set the stage for a revaluation of these metals. Gold's potential to reach new highs is underpinned by its role as a hedge against currency debasement. Silver, with its dual role as an industrial and monetary asset, offers even greater upside. As the public and institutional investors alike return to these markets, the resulting demand surge could drive prices to unprecedented levels. For viewers and investors, the message is clear. Don't wait for the headlines to validate what the fundamentals already suggest. Gold and silver are not just investments, they are lifelines in an era of economic uncertainty. Whether you're a seasoned investor or new to precious metals, now is the time to act. Accumulate gold and silver while sentiment remains bearish and valuations are attractive. The coming years promise to be transformative, and those who position themselves today will reap the rewards tomorrow. And let's not forget to enjoy the ride. As Schiff aptly puts it, gold moves on broader, glacial reasons. So buckle up, embrace the journey, and remember, the best time to invest in gold and silver was yesterday. The second best time is today.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.